Most of us picture global trade as a straight shot across an empty sea, massive ships gliding easily from one continent to another. The vast majority of our essentials, from the fuel in your car to the phone in your pocket, reach us by navigating through a series of incredibly narrow, fragile maritime shortcuts. When ships abandon these shortcuts, the math changes instantly. This is the standard route through the Red Sea. Detouring around Africa adds 6,000 miles, translating to nearly 2 extra weeks at sea per shipment. Exactly 7 of these core choke points dictate the flow of the world's commerce. When even one fails, shipping rates surge and supply chains begin to stall. The first domino in a sequence that drives global costs higher for everyone. The first major threat to these pathways is active geopolitical conflict. Look at the Bab al-Mandeb, known as the Gate of Tears, sitting at the entrance to the Red Sea. Recent drone and missile attacks have transformed this commercial corridor into an active military zone, forcing many transport ships to avoid it completely. Then there is the Strait of Hormuz. This is the energy lifeline of the planet, handling roughly 20% of the world's oil and gas. In 2026, conflict surrounding Iran sharply reduced traffic through this strait. Commercial vessels either have to make special arrangements to pass or delay their routes entirely to avoid getting caught in the crossfire. Regional conflicts in these gates squeeze the global energy supply, forcing immediate fuel price spikes that impact every corner of the market. The second threat comes down to physical limits. We are forcing massive modern trade volumes through historic waterways that simply haven't grown in size. Right after the Bab el-Mandeb sits the Suez Canal, forming a heavily congested link between Europe and Asia. In 2021, a single container ship, the Ever Given, got wedged completely sideways. That one navigational error paralyzed $10 billion in global trade every single day it was stuck. Or take Asia's primary choke point, the Strait of Malacca. It has to handle 94,000 ships a year. The extreme density of vessels sharing such a tight lane makes it incredibly fragile and highly susceptible to piracy. You see the same risk in regional commodity gateways. The Danish Straits, a key route for Russian oil, are notoriously shallow. Meanwhile, vessels navigating the Turkish Straits, the only exit for Black Sea exports, must squeeze past heavy urban shores while fighting strong currents and dense fog. As global commerce continues to scale up, the physical dimensions of these waters remain fixed. That mathematical mismatch guarantees that basic navigational errors will continue to trigger sudden commodity shortages. The third threat operates entirely in silence. Environmental shifts closing off the routes. To move goods between the Atlantic and Pacific Oceans, ships rely on the complex, tiered lock system of the Panama Canal, but those locks require massive amounts of fresh water to operate. Severe drought conditions in recent years have dropped water levels so low that authorities have had to strictly cap the number of daily crossings. Nature acts as a stealth choke point. It imposes widespread delays and pushes up shipping costs without a single shot fired or a ship running aground. While other waterways certainly exist, like the Strait of Gibraltar, they don't rival these core 7 in terms of raw scale or danger to the broader economy. Over decades, international commerce made a calculated trade-off. We sacrificed network resiliency for extreme efficiency, funneling almost everything through these tight lanes to save time and money. The result is a supply chain that behaves like a house of cards, highly vulnerable to localized failures. The next time you see a sudden spike in gas prices, or your weekly groceries cost a little more, the cause might not be a shifting market. It might simply be a single blockage in a narrow strip of water halfway around the world.